All right, mic test. All right. Perfect. All right, we're all good. What is going on, everyone? A little late night stream. Hope everyone's doing well. Let's see how tonight goes. Hope you guys are handling the volatility. We are back with some violent moves here, guys. Doug, what's going on, man? How's everything going? Rough day today. Rough day today. Even though the market didn't show it, only down 0.2%. A lot of damage underneath the surface. Hope you guys are diversified and at least didn't feel the pain too badly. How's everything sounding, guys? What did you miss? Yeah, so today is interesting. I don't think we can really put too much emphasis on one news like headline. I think most of the concerns today are around Japan, them potentially hiking rates, even though it's like 98% expected, and that unwinding this carry trade whereby you borrow in cheap uh, Japan interest rates to invest in higher interest rate environments like the United States, for example. Can you believe I still have this cough after 3 weeks? Logan, what's going on? So people are nervous that we're doing our cuts, Japan's doing their hikes, and you have a situation whereby that's weird. I just got a notification from TikTok about using someone else's content rights. I don't know how. Never mind that. Okay, where was I? Sorry, weird notification. So, as I was saying, now the concern is that if Japan increases rates, whilst we're cutting our rates, it could now move the yen to make a strong move against the US dollar. That hasn't been the case. We had a little bit of a scare around a year ago, um, whereby the yen started gaining on the US dollar. But right now, guys, you know, let me get this out of here, man. Hold on a second. Sorry to bother you guys there. I cannot believe I'm still not 100%. So, put simply, I'm watching, and you guys should be watching too, USD yen. I'll show you guys right now. The news stories keep bringing this up, but I'm not. Why is the currency not being impacted more? Check this out. We're back to essentially January levels. Now, this pullback here, okay, the strength in the yen against the dollar is what started worrying people about the unwind of the trade, because you convert your currency, right, to yen, you borrow a ton in their low interest rate environment, and then you make arbitrage, you lever up and invest in higher yielding assets elsewhere. That's great until the yen starts to strengthen and their rates start to go up while ours come down. So, I mean, so this was the headline today, to make a long story short. And I'm not seeing, like, take a look here. You got the US dollar pushing up against the yen right now at near all-time highs. All right? It's almost as if, how can I put it another way? Anytime there's volatility in the market and we don't have a plausible reason, it's kind of like the news sources just go straight to this as like a backup argument. When there's a 98% probability that Japan's central bank is going to increase rates. So this is largely expected. You see the moves in their yields happening right in real time. Yet the yen is not gaining at all on the dollar now. At all. So if this unwind is happening, and I keep asking people this question, why are we not seeing the dollar weaken against the yen? It's not happening yet. So it almost looks to me like this is news sources just reaching for some kind of reasoning as to why the market might be seeing some pressure. Because and if what they're saying is true, then essentially it's people having to, sell their assets and unwind their trade of borrowing in yen, borrowing cheap yen debt, okay, denominated yen debt, and then investing elsewhere. But again, if that unwind was happening, we would see the yen start to strengthen against the dollar. It's not happening yet. And I'm wondering if this is for a couple reasons. One, Fed came out and said we're only expecting one cut next year and one cut in 2027. The less we cut, holding all things equivalent, we should see a stronger US dollar. And then secondly, I think there's a possibility that the Supreme Court repeals these tariffs that could also help the dollar out. Because if you remember, this pullback here was heading into tariffs. When Trump tacoed out, that's when the USD started gaining back on the yen. So let's see here. But Doug, again, I just went off like 5 minutes about that. But this is what I was seeing as a potential headline. Some liquidation happening, especially in the crypto markets. But I'm not seeing it reflected in the currency. So that's why I'm not sure how much we could put weight on that, long story short. But that is what they're saying when they don't have a good headline. I think that's what they're going at. Dawson, what's going on, man? No. We're sticking to the private live stream to discuss all of our stocks, everything I own, no strings attached. That's happening Wednesday night on Zoom, 6 p.m. Eastern Time. For those that are curious what I'm even talking about, I host private live streams for Cube subscribers, Cube members only. Green, red, or blue members. Does not matter which one. You got the invite. It is in your inbox. That is being held on Wednesday night. Turn your cameras on. Turn your mics on. Let's have a nice back and forth. All questions, fair game. You want to talk about our highest conviction holdings? Let's do it. You want to talk about things that worry about the economy? Let's do it. That's going to be a really, really fun time with all of us. Thoughts on Microsoft? Nick, I'm a huge fan of Microsoft. What can I say about it? I think the valuation is somewhat fair. I still think, even though right now Google's Gemini is probably taking a leap ahead of ChatGPT. We'll see with ChatGPT's new version how that competes. Put that aside, though. Azure growth is beautiful. Microsoft's suite of products is second to none. You've got the Activision angle. You've got the Xbox angle. You've got the LinkedIn. It's just a conglomerate at this point that I just don't think can be toppled. Ben asks, is options gambling? Why? Ben, depends on what kind of options we're talking about. I like to use options for selling covered calls. I would not say that's gambling. I think if you're taking risks on, for example, to play 0 day to expiration NASDAQ QQQ calls, you got yourself a different story. That's pure speculation. I think the way I use options, I don't consider it gambling because I usually use it to generate passive income against my portfolio or to hedge against any downside that I'm nervous about in the market. Corey, what's going on, bro? How's everything? So yes, Doug, I just saw your question too. Is this affecting crypto as well? Yes, and Doug, I think the reason that the whole carry trade with the yen concerns is affecting crypto is because that's where you see a lot of leverage. Doug's got 2 cover call expiring Friday for 100% gain. Let's go. Dude, covered calls, if done wisely, are cheat codes, man. You have to pick your spots. You got to be careful, of course. But I got a guy that makes $200 to $300 a week doing it. And I've been doing it with him now for 3-4 years. $200 to $300 a week is making passively against his cover calls. We sell them every single Wednesday. What do you think about the Warner Brothers deal with Netflix? So, Nick, that's not currently the most favored deal right now. In fact, right now, Paramount topped Netflix's like $83 billion offer, and they're essentially offering like a $105 billion enterprise value for Warner Bros. At $30 a share. So right now, Paramount's offer is actually the best, and I hope that Paramount gets it for multiple reasons. One, for the first time in a very long time, I'm actually considering buying Netflix. I think this pullback from like 134 to like low 90s is starting to look attractive. I have a specific price that I want. My subscribers know what that is. They're going to know exactly what number that is because I'm issuing a Netflix model in the coming days, along with an Amazon model and another model that I can't say because it's a very exciting company that I think you guys are going to be very interested in seeing with my price target. But to the Cube subscribers, the red and the blue members, you will be getting a Netflix and Amazon model in the coming days, plus one other company. And I also updated my Broadcom model today as well. So there's a number, Nick, that I have in mind. I think this dip is getting very, very attractive from 130 something, like 134, I think it topped out at, to 93. Because I think the market's concerned that they're actually going to go through with this buyout. And I think there's two ways to look at this. One, I don't think the deal happens. Corey, sure thing. Offline, let me hit you up. You're going to be getting the model, and hopefully either tomorrow, this week you're getting it. You're either getting it maybe late tomorrow after market closes, or maybe Wednesday morning. So here's how it works with regard to Netflix here. If Warner Brothers goes with Paramount, they actually owe about $3 billion breakup fee to Netflix. If Netflix backs out, or the FTC shuts down the acquisition for monopolistic purposes, then about $5 billion or so, maybe almost $6 billion is owed to Warner Brothers from Netflix. I think the market is pushing Netflix down because they are concerned that Netflix is going to try to up the ante now against Paramount. I don't think that's wise to do. I just don't even see how this deal is going to get approved, quite honestly. Even if Netflix comes in at a $110 billion offer, $115 billion offer, now I feel like you're overpaying. And the FTC, I still think is going to say, nope, we're not letting this go down. And then it would all be for nothing. They'd pay a $6 billion breakup fee, and then probably Paramount comes in and reoffers their $30 a share, and it goes to them. As a consumer, I don't want to see it happen. I don't want to. I want to have more choices. I want more competition, and I'm also concerned as a movie lover what Netflix would want to do with the studio aspect of Warner Brothers, right? So from a investor standpoint and from a consumer standpoint, I don't want to see the deal go through. I don't want to see it happen. Give it to Paramount. See what they can do. I think Paramount becomes a real competitor if they get the approval. When you think about UFC, HBO, everything under one roof, DC. I mean, that's fun. That's exciting. I want to see what they can do with that. And yeah, challenge Netflix. Don't let them own the whole entire, business, and go from there. UFC is with WWE, no? They're both part of the same parent company, TKO, which I did really, really well on. I'm no longer in the stock. I sold my last remaining shares at like 190 almost, give or take, after getting in at 88. Killed that. Props to everyone in here, especially Corey and all you guys that took advantage of that stock. That was a breeze to own. That was just up and to the right. But here's what's happening. TKO markets their deals for, whoever's going to, the highest bidder essentially. So they did a $5 billion deal. Excuse me, what was it? For Monday Night Raw, it was a 10-year, I think $5 billion deal for WWE rights for Monday Night Raw. But they did the UFC rights with Paramount. That was a $7.7 billion deal. So TKO, the parent company, doesn't really care. They're not loyal to one streaming platform. They essentially, it goes to a bid. So they've got WWE going towards Netflix. They've got UFC rights going to Paramount, and the like. So Dana White killed it. The reason I sold the stock is now because it's such a highly predictable company where, because of the contracts and how they're situated, you could model out the next 10 years of revenues essentially to the dollar almost on UFC and WWE content rights. So there's not really going to be much surprises when it comes to UFC revenue and earnings. So because that's out of the equation now, the surprises, it's now going to be a less capital appreciation play and now a very, very gratuitous dividend share buyback play, deleveraging play. So that's why I sold. I initially got into the TKO stock because I thought the market was underpricing the value of their assets. Okay, I was right. We more than doubled our money. But now I don't see it doubling again, for example. Now it's going to be a steady up and to the right, I think, continuously, but with way less percentage return. But now I think they can get to a 3 to a 5% dividend yield, buy back shares, pay down debt, and pretty much handle any kind of economic environment, which people are going to love. So that's also going to lead to maybe a little bit of earnings expansion, a multiple expansion. So I still think it's a good stock, but it's no longer serving the needs that I'm looking for, which is capital appreciation with my growth-oriented portfolio, if that makes any sense to you guys. If not, I can always elaborate further. Dawson, is the UFC doing the White House fight? I believe they are. I think they're still working out the details. Doug, I didn't watch, but I did hear Cena's last match was a little underwhelming. And Corey says, Cube, you called the terms of the UFC deal. Thank you, Corey. Yep, my model was 1.1 billion a year. That's what came in. But I will admit, I did not think Paramount. To be fair, I don't think anyone did. I don't think anyone thought Paramount was going to win it. My gut was saying it's going to be Prime, Amazon Prime. But it doesn't matter. We got what we wanted. The numbers came in the way they came in, and we killed it. Oh, Corey, is that for sure? It's July UFC White House? I heard a rumor that every single fight is going to be a title fight on the main card. I heard there's going to be 5 or 6 belts on the line, which would be absolutely insane. And I'm going to go ahead and guess, too, it's probably going to be an additional pay-per-view on Paramount. So you can probably have to have a pay-per-view subscription, a Paramount subscription, and then pay additional for the pay-per-view for that one additional event. I am so grateful that the UFC listens to their customer base and is now going to start making the main events at 9 p.m. Eastern Time. That extra hour means everything to me. Nick, SoFi, I don't own this stock. I never have, just because their business model is quite complex with how they make their money. So if I can't comfortably and confidently model a company, I usually don't pull the trigger. So I've been on the sidelines watching this thing run higher. What I will say is the way they beat and raise guidance is just insane. Nick, what's going on, bro? How you been? So I gotta tip my cap to SoFi on what they've been able to do. Guys, I am watching my platform here. Am I lagging? Is my movement lagging at all? I wonder why that is, if it is. I'm looking at my studio here. Just let me know if it's lagging on your end. If it's not, then good. It must just be my platform then, my studio. As long as it's not lagging on your end, I don't care. Thanks for the motivating. What's going on, man? Good to see you here. Nick, good bro. Good to see you, man. How was your travel? I haven't traveled since the summer. But all my travels have been good, man. What you been up to? Name, it says just you. Okay, thank you. Thank you for the response. Appreciate it. All right, because I was just watching and it was looking like it on my end. So as long as it's not bothering you guys. So what other tickers you guys want to discuss? Fubo, Corey. I don't like the gross margins on Fubo. I don't like the path there on profitability. They're in bed with Disney now, which has the stock even been doing anything? Nick says, "Oh, I thought you were going to do a month trip travel." I did. I was gone for 4 months last year, Nick. I was gone this summer for a little over a month. When I do leave the States, I'm usually gone for a while, though. I'm not going to lie to you. I don't have any long-term trips planned right now. I don't. But I tend to do things on a whim sometimes. So I might just go ahead and say, screw it. Let's go hang out somewhere for a couple months. Yeah, it's been bleeding out, man. Oh, also, guys, I enabled my cursor to now show on the screen. So this way you guys can follow where I'm looking. And by the way, guys, right above my finger here, there's a rectangle Click that button if you want to make your screen go sideways, landscape mode. This way you can see my screen way easier. It'll be much more visible. All right? Braden, what's going on? Nah, Nick, it's all good, bro. Time's flying so fast, man. I don't blame you. Look at the calendar year, bro. We're going into 2026. Where did 2025 go? By the way, guys, peep the Rutgers logo right there. I figured, it was the right time to break this hat out. Just for the winter. Shout out to New Jersey for finally snowing more than 4 inches. Feels like the holidays now. All right, so Fubo's really... Wait. Okay, what's going on here with Fubo? There's really going to be a $4 billion revenue leap starting next year? Doug, this next 2 days can be like, I think real feel like 8 degrees. Okay, the Disney deal is really leading to that much of a step up in revenue? That's crazy, because you're looking at 5 times next year's EBITDA. That's crazy. You're looking at 25 times next year's earnings on an estimated 10 cents? What's going on here? Because this then looks quite attractive. I mean, I'm probably still not going to pull the trigger. I'm not going to lie to you. But this might at least help put a bottom in the stock. I just look at the gross margins, man. Oh, God. Like, sub 20% is disgusting. How do they get to that number? How is that possible? I mean, listen, if you're doing an extra $4 billion in revenue, I mean, and you only, like, these margins are weak. $200 million in EBITDA and $6.3 billion in revenue. And both analysts have the same exact number. It's almost as if it's contracted. It's hard for me to say sell at a 5 times forward EBITDA multiple, Maybe see this one through. The sports licenses, they're really going to bring in that kind of money? Is it, like, what's the structure of this deal? I'll get to Fox in a second. Like, what's the structure of Fubo and Disney, man? Let's look this up. Let's see what we got here, man. I hit accept cookies, but I got no idea what I'm accepting, man. Like, I just be agreeing to some shit. I should probably say deny all the time. I didn't see that, Dawson. Beckett, the second best grading company, got bought by PSA parent company. Oh my God, they're taking over the market. Let's just go straight to Fubo's investor relations here. Let's see what we got. Where the hell is everyone tonight? Yeah, they're cornering the entire market there, man. Now GameStop should go and buy them out. See, this is what I'm trying to figure out here. Disney owns 70% of the company now, and they're combining Disney's Hulu plus live TV. So what exactly are the combined... What's the combined entity now? New offerings like our Fubo Sports Skinny service and pay-per-view platform are giving consumers more choice and control than ever. And as we combine with Hulu plus live TV business, we're poised to create a next-gen pay TV company built for scale, personalization, and profitability. Let me see here, guys. I'm just curious. I need to know. I just need to know how this is going here. One second. They don't got any presentations for us, man? On like the merger? Disney is helping them fund rebuying their stock. Okay, that's good for the stock price maybe recovering. But I'm just saying, like, is Fubo sharing revenue with Hulu Live TV? Is Disney paying a fixed number to Fubo? I'm just trying to further understand here that $6 billion, where it's coming from. Like, anytime I see a $4 billion jump year over year in revenue, I got to ask, especially when you're a $3 billion market cap, what am I missing? What am I not understanding here? You know what I'm saying? Okay, what is this right here? With Mouse House's acquisition of Fubo, the original litigation to stop Venue has been dismissed, but other pay TV providers are raising their weapons. Dish and DirecTV argue that Fubo's original case failed to address key issues and accused Disney of buying the company to prevent an antitrust fiasco. We'll have to see if these arguments stir the courts, but in any case, investors have been stirred. Fubo rose 258% last week. At Disney, which already owns Hulu plus Live TV, will now boast 6.2 million subscribers and over $6 billion in annual revenue for its pay TV services. Look out YouTube. Okay, then I have to, this number of 6 billion. This has got to be the combined. This is not organic growth. This is inorganic growth. This has got to be what Hulu plus Live TV and Fubo do together now, and that's what Fubo is reporting as their revenue. Am I understanding this right? Is that where that 6 billion comes from? Fubo, Disney. Do we have a presentation on this anywhere? You're saying no, Corey? Nick, I think Robinhood's a little too expensive, and I'm concerned that next year, and again, I've not read this anywhere, that legislators maybe want to press them a little bit on their prediction markets business. Cause I've talked about this a few times on streams now. I don't think that should be illegal. I know Disney did not buy Fubo, but when you take a 70% interest, that's a majority. I would imagine it's now a controlling interest. So I'm just wondering now, how does the accounting work here? Because this is where things get a little weird. Fubo's existing management team will operate the newly combined Fubo and Hulu plus Live TV businesses. This has to be it. So Disney owns 70% of the newly combined company. And the newly combined company is Fubo and Hulu plus Live TV. Okay. So then they've created a new company. I see what you're getting at here. Disney does not hold any interest in Fubo stock. I think what you're saying is Fubo and Hulu plus Live TV have created their own entity that Disney now holds a 70% stake in. But that also answers my question, which is this $6 billion plus in revenue for next year, is not Fubo saying, hey, we won new contracts and this organic growth. That is the combined revenue of Fubo and Hulu live TV. That's what's happening here. And with that being said, so why is the market so nervous about paying 5 times next year's EBITDA? Why is that an issue? And they did that to stop the whole antitrust fiasco. I see it fully. This should not be a 5 times forward. What am I missing? That's the issue here, Corey. All right, so we'll have to see how this pans out. I mean, how could I say, hey, listen, $6 billion in revenue next year, $200 million in EBITDA, 10 cents in earnings? How can I say, hey, this stock doesn't deserve to trade down here? Like, it deserves to trade lower? To what? You want to give it a 2 times EBITDA multiple? So I'm a little confused here because look, see, after they were inorganic growth, then they're talking very little growth afterwards. So I'm not sitting here and saying this should probably trade at 25 times EBITDA because you're probably not going to get the most growth going forward. But 5 times, that's odd. Unless, of course, these numbers are wrong. Hold on a second. One second. Fubo is trading at a $3.4 billion market cap. Give me a minute. This number might be wrong because this is an enterprise value. Okay, so we're taking into account net debt here. What's Fubo's balance sheet look like? $280 million in cash. What's the debt? Why are you not putting your balance sheet right here? Why, man? I hate that so much, man. Just give me the goddamn balance sheet. Oh, come on with this bullshit. $275 million in cash. $186 million of long-term convertible notes. 144, take the 4, 190, 330 mil. So call enterprise net debt like plus 30 million, right? So Fubo's real enterprise value is probably around 3.5 billion. 3.5 now over 205. There you have it. That's what it is, Corey. It's a fucking screw up on my platform. It's not 5 times. And this goes back to what I was saying. This should not trade at 25 times EBITDA. But it shouldn't trade at 5. 17 is appropriate. 17's appropriate here. That now this makes sense. This is a screw up on this platform. This is not a 5 times EBITDA because that would assume then it's $1 billion enterprise value. 200 mil times 5 is $1 billion. This is not $1 billion enterprise value. It's a $3.5 billion enterprise value, which takes the actual multiple to 17 times, which actually looks kind of fair now. Now we're talking. Now I can see that there's the disconnect. Took me 25 minutes, but at least you got to see the walkthrough in my head. All right, let's get back to some questions here. So, Corey, this looks all right. Maybe it deserves to trade closer to 20, 22 times. But I don't think this is going to 10 if you ask me. Not right now. I don't think it's going. This might take a while to get to, your 7 to 10 ballpark. All right. So I wanted to put a bow on that tonight. So that is finally now. When you asked about Fubo, now I got it squared up. All right. Let me get back to some questions here. Do you think Pepsi looks good in the future, Casey? I like Pepsi to an extent. I probably won't ever own it, even though it's a nice stable name. Along with Coke. You have any concerns, Casey, about everyone on these obesity drugs maybe just losing interest and losing the appetite for some of these sugary beverages and whatnot? And also, like, well, that's more than just beverages. They also have their, their chips and all that kind of stuff. You're concerned about that hurting demand at all? Because I don't think revenue is expected to grow all that much. And I do think, though, they did have a change in C-level executives. I mean, you're looking at 3% revenue growth here, man. This is pretty much after inflation. You're looking at real revenue growth of 0. You got a 13 times multiple, 17, 18 times next year. It looks very fair. Like, I wouldn't call this a bargain or cheap. And if you're looking for yield, 3.7% dividend yield looks okay. I wouldn't say it's like anything to write home about. So it just looks like whatever to me. I think that's a large reason why it's only up 3% this year while the market's up 16, 17. So it's fair. I really want to make sure you guys understand here. When you're looking at the market, guys, assume you're wrong first. Assume you're missing the picture. And assume that the market knows more than you do until you've truly crossed your T's and dotted your I's. The market's a little bit more efficient than you think. I'm not on the full bandwagon that it's perfectly efficient. That's not true at all. The way we see movements today, it's not true at all. Maybe semi-efficient. So whenever you're looking at these things, that's why I'm like saying to myself, there's no way the market's saying 5 times forward EBITDA for Fubo. So question yourself a little bit, because the second you stop questioning yourself in the market and you start thinking, I got this shit down pat, your greatest lesson's coming. Thoughts on Costco? Nick, Roth Capital actually put out a sell target on Costco this morning, citing competition headwinds, same-store sales growth decelerating, potentially sequential drop in memberships quarter over quarter. I've been saying now for over a year, I just think Costco is too expensive. They slapped a $790 price target over there. Let's see here. Because, I mean, don't get me wrong, I love safety. And this is why it fell 2.7% today when the market was relatively flat. I'm all about safety, trying to protect your portfolio. But, Costco is pushing 50 times earnings last year. Now, with the drop year over year and going forward on earnings growth, the multiple has compressed now to around 40 times earnings, which still is not really that much of a bargain to me. So it's decent, but this is probably still not a name I'm looking at. Like, if I'm looking for safety, I might actually take a stab at Walmart, maybe BJ's Wholesale. If I'm looking for true safety, maybe I go with some Waste Management or something along these lines. Because don't get me wrong, it's a juggernaut of a name, but I'm still paying over 40 times earnings for this name. And if there is any slowdown in their business, the market's going to be quick to take a hack at them. Let me see here. DCB, you said the addiction is real. What are we focusing on there? Doug, they own everything we drink. Yeah, you ain't kidding, man. Even bottled water, exactly. I think, who owns Dasani? Is that Coke or Pepsi? That is the worst water ever. Have I ever read Snowball? No, I have not. Assuming you're wrong first sounds like something my wife would say to me. Brandon, yeah. I mean, if that's probably the sign like of a healthy marriage, man. You just gotta start by thinking you're wrong first. And if you're right, you're gonna be wrong. Let's see here. Florian says HCA, VHT, REGN. What you think? Florian, I'm sorry, dude. I don't know anything about any of those three. I wish I could be a little bit more help to you, dude. CRM, motivating CRM. I'm okay with it. If you truly believe agentic AI is the wave. It's hard now to like get mad at CRM because the valuation really isn't hard to justify anymore. The thing's down 23% while the market's up 16, 17 this year. I think their investor day is calling for $60 billion in revenue by 2030, so the market's still undercutting that with the $59 billion consensus. If they can hit $60 billion, I think that would imply a 10% CAGR, which is the real threshold for them to really unlock bigger multiples. The second that CRM fell into single-digit revenue growth, the market compressed their multiple. If you don't know what that means, I can elaborate more for anyone listening. So I think that if the agentic AI business can get them back over 10% growth annually, you might be looking at, instead of Salesforce trading at 13 or 15 times forward EBITDA, maybe they'll start saying, you know what, this should probably trade closer to 20 times. It's going to be hard to trade any higher than that. But I think Salesforce looks decent here. I do. You know, you're paying 20 times next year's earnings, and you're getting 15% earnings per share growth, which is a lower multiple than the S&P with better earnings per share growth. So as a benchmark to the SPY, it actually looks slightly favorable. And I do think there's a possibility that they beat these numbers. Let's take a look at Fox here. Guys, if you think that these streams are entertaining or insightful, you have no idea what you're missing out on a Cube subscription, man. I'm telling you right now. This is my free content. Can you imagine what the paid content looks like? With my hundreds of pages of research reports, my top stocks, private live streams. By the way, the private live stream on Wednesday night is going to be a lot of fun. A lot of fun. That's going to be, you know, us talking about anything and everything. Motivating. I know you didn't just ask CRM. Is there like a 5-minute lag? Is there a 5-minute lag on my chat? There's no way I'm being asked. Motivating's asking me about CRM again. There's no way. Corey says, building my schedule around Wednesday night. Motivating, you're killing me, man. You're killing me. All right, I just spent like 3-4 minutes on it, man. Essentially what I was saying was, it looks like I see some upside here. No, Drago, he's asking the symbol for Salesforce. He knows it. He was asking me to provide some color on it, and I did, and he wasn't here for it. And then he asked, what about CRM? And I was like, I just finished answering it. I'm going to get to some of the questions in a little bit. Give me 1 second here. Because we were looking at Fox here for a while now. We're talking about getting to it. So let me get to it now. All right. So, what, if I'm not mistaken, if I'm trying to think of your rationale here, I'll get to all the questions because it's kind of slow night, so I shouldn't miss any questions tonight. If I'm trying to step into your mind, Braden, about why you're interested in Fox, I'm going to assume it's because now you're thinking, okay, if the market was mispricing Warner Brothers assets that badly, maybe there's a good chance they're also mispricing Fox's assets that badly as well. And that the true value of their assets is way higher than the you know, your normal everyday public investors are giving them credit for. If I had to guess, that's probably somewhat of your mindset here. Because as far as revenue growth goes, you got really virtually no dividend. You got a sub 1% dividend yield. And you've got no revenue growth expected for the next 5 years. You have maybe a small little bounce back in EBITDA next year. So you're trading at 9 to 10 times EBITDA multiple, which probably now when you're looking at what Warner Brothers is fetching, you say to yourself, hey, this is pretty damn cheap at, you know, 15 times forward earnings. So from a sum of the parts is greater than the whole aspect, I see 100% what you're going for. Because, like, what are they willing to pay for WBD right now? They're willing to pay $30 a share, which is equivalent to paying, I can't even really use that as a metric. They're willing to pay what appears to be like, I can't even trust these numbers anymore, man. Because, like, this is not, I don't know why Koifin's messing up today. Because if I go, Paramount's offer is $108 billion enterprise value. Okay? If Warner Brothers is going to do $8.7 billion in EBITDA, 108 divided by 8.7 is around a 13 times multiple, right? That's what they're willing to. Now, granted, there's a control premium being built in here. Now, Fox, they've pushed Fox here. Even on this run, it's still trading at like a 10, call it a 9 times forward EBITDA multiple. So if you say to yourself here, okay, well, Warner Brothers is getting bought out at a 13 times multiple. Perhaps Fox is still cheap at 9 to 10 times here. The reason, though, Braden, that's not fully comparable, if that's what you want to go apples to apples here, is because when you are acquiring a company, you are paying the control premium. So you can't expect Fox here to trade at, if you want to go apples to apples and say, well, okay, Warner Brothers is getting bought out at 13 times, that means Fox should trade at 13 times. No, that should only mean then if we're going apples to apples here, that Fox should only trade under 13 times if they are getting bought out. Okay? But, so to me, after this 48% run, I would say this looks kind of like fair value at this moment in time. Again, yeah, I'm sure the balance sheet isn't all that pretty. We can take a look at it here. I'm going to get to your questions, guys. I'm going to get around to it. I thought that balance sheet would actually be far worse. That's actually not terrible. That's not bad at all. That's a decent coverage ratio. Free cash flow is like $3 billion a year, $2.7 billion. You're paying like 10, 11 times free cash flow. I mean, it doesn't look expensive by any means. I would say this looks somewhat fair, maybe a tad undervalued still. But I will say, though, Warner Brothers assets are way stronger than Fox's, in my opinion. That I will say. All right, what's up with Oracle, Drago? What's going on with Oracle is that they have been taking on a ton of debt to go after their AI ambitions. They're jeopardizing their balance sheet in order to capture what they believe is a massive opportunity in AI. That backlog, that order book they have in AI is very dependent on OpenAI, Sam Altman's company. There has been concern since October 31st's interview with Brad Gerstner of Altimeter Capital that is making people nervous based on Sam Altman's responses to how he plans on fulfilling his $1.4 trillion in spending commitments. It's making people nervous that he's not going to follow through. Oracle is taking on a ton of debt with the assumption that OpenAI is going to be there. With that being said, the stock has now pulled back 45% from highs. It has now faded all of their AI runs for the most part, and some. I would say now the risk reward does look pretty attractive in Oracle. I'm probably still not going to pull the trigger because I'm really not a big fan of Ellison. And I also look at the credit. I always like to think the bond market's smarter than the equity market. The way the credit spreads are widening for Oracle also makes me wonder and have some concern that people are nervous that they are taking on too much debt here. They are jeopardizing the health of their balance sheet. I think this is going to be a pretty big conversation this time next year when we talk about the blue chip safe haven mags, your Microsoft's, Meta's, Google's, and the like, because people love them the last 15 years because they were generating strong free cash flow. Balance sheets were relatively healthy. I mean, for crying out loud, Microsoft, I think even till this day, has a higher credit rating than the United States government, which is just crazy to think about. So if you look at credit spreads, the risk that's being implied on the debt of Oracle, on the health of their balance sheet, on the credit spreads and the health of Meta, it is signaling some concern. And I would say this is all still okay for now because the market is being patient and saying, look, we understand you need time to invest in AI and generate a return. But if we fast forward the clock another 12 months and that path to a profitable return on investment is not showcasing itself, I think the market will start to say, whoa, whoa, whoa. We invested in the mags because it was strong free cash flow, it was healthy balance sheets, and it was easy and predictable future revenues. That is no longer the case now, and I do think that could cause a little bit of a ruckus in the market come next year. Now, why do I say sometime around this time next year? Because this is around the time that you will start to see the Magnificent Seven start to lay out their capital expenditure plans for 2027. And if they're not generating a positive ROI, or at least a very clear path to positive ROI throughout all of 2026, and they start to readjust their future expectations for capital expenditures for 2027, it might bring this whole AI question, this whole AI theme into question. Do you follow? So yes, Oracle doesn't look half bad now to me. But I have some general concerns holistically about this whole AI movement. I'm not really questioning the technology, although I've been very, very clear that chatbots are cool, but I don't think they're life-changing. I think the real opportunity in AI is physical AI, and that is where I'm invested in, and that's what's been treating me well. Don't get me wrong, I still own the S&P 500. I still own Microsoft. I have other plans for other investments as well. But I believe the robotics and physical AI movement is what is going to be the true difference maker in my portfolio. It already has been. It's a lot of the reason I'm up 30-something% this year. I think it will continue to be a huge driver for my portfolio. But even more importantly than my portfolio, a huge driver of actual GDP growth and improvement in life. I think that's where we're going. Everyone talks about, hey, we're going to be all out of jobs, with all this, autonomy and stuff. If you actually look at it, we are going to have, especially the way we're not getting married today, the way we're not having kids today, forget overpopulation. With the aging population, we are going to actually need help from robotics and autonomy to keep GDP afloat and spend our time on more important matters as opposed to, repetitive tasks. I think it's a necessity, robotics. And I just, even on a philosophical level, I just believe humans are meant to do more than just repetitive tasks, like tap into your creativity, more personable, jobs, things like that. Well, Jacob, I think the same thing was said when the horse and buggy was put out of work when Ford developed the assembly line, Winters, what's going on, man? I would agree. I don't think it's happened just yet, but I think that's going to be a theme later next year. Nick, I like Boeing. A little expensive here, but I still like it. It may be more robotics and AI combo next year. Drago, that's what I'm thinking. Robotics and AI combo next year, and I'm also investing in that. So I'm putting my money where my mouth is. So I'd love for you to know what those names are if you'd like to join Cube, and we can hop on a 2-hour meeting. The second you join and subscribe, you get a calendar invite to a 2-hour meeting, along with getting all my research reports and knowing what those stocks are. You knocked it out of the park with the Oracle sponsor. Winners, thank you, man. It's good to see you here tonight. But I do think that's going to be a growing question, as you mentioned. That's a big concern. It's already in my preliminary research and commentary on my 2026 annual economic outlook that I'm issuing in January. I really want you guys to be subscribed so you can see that 100-plus page document on where I think there's risks in the economy, where I think there's opportunity, what I'm staying away from, what I'm even getting closer to and wanting more of. Let's keep going here. SPMO. What do we got here? I got to scroll back here. Momentum ETF. What do we got here? Broadcom, Nvidia, Meta, JPM, Palantir, Netflix, Walmart. I mean, it looks solid. I like Broadcom. Not the biggest fan of Nvidia. Not the biggest fan of Meta. I think JP Morgan's properly priced. I think Palantir is overvalued. Netflix is starting to get attractive. Walmart's good. This looks okay. Nothing too crazy. Momentum is a big thing in the market. That's why it is outperforming the S&P. But the thing is, you got to keep your finger on the pulse here, because when momentum fades, the bottom tends to fall out quicker on these names. DCB, I like Coherent, but after this run, I think fairly valued. I think now it needs time to build into its valuation. I've been saying this about Coherent. It's like 120 a share. I'm kind of pissing myself for not taking my own advice. That would have been nice to get into. Nick, I used to own Take-Two Interactive. I sold. I don't feel like waiting another year for GTA 6 to come out, even though when I do think it comes out, it's going to be absolute money maker. I can see them doing $1 billion in sales in the first 3 hours. I have that whole entire company modeled out and everything. We killed it. Me and the Cube subs got at 140 and change, sold at 230. All right. Let's see here. Can you explain why investors are willing to buy stocks at higher multiples? Roar, are you still here for that question? I'd love to answer it. You still here, Roar? Ruben, what's going on, man? And don't worry if you're not going to make the Wednesday night stream. I will post the recording. So don't worry if you can't make the live stream on Wednesday night, the private live stream. Stock, are you here as well? I can give you a quick chart on Ethereum. All right, Ethereum here, I think, man, I'm not going to lie to you. Oh, man. Ethereum looks like hell. I could see 2250. I could see it bottoming out around 2250 to 2435. I'm not even kidding. This chart looks like hell. BTC looks just as bad. I can see Bitcoin here. I think Bitcoin's heading back to 80. If 80 gives out, 76.9. So, Roar, why are investors willing to pay a higher earnings multiple or higher EBITDA multiple? Very, very good question. So glad you asked. The more predictable a business is, the higher they'll pay for the multiple because they can trust that the number is going to be there. That is why you will see a recurring software company like Microsoft trade at a higher multiple than Exxon. Why? Exxon is cyclical. It's very hard to predict where Exxon's earnings are going to be next year because it's reliant on the price of oil heavily, and the price of oil is in the hands of many, many economic factors. So reliability and forecastability is also a big reason, not the main, a big reason for why investors are willing to pay a higher multiple. Secondly is growth. Who is growing faster? Because then I start to say, oh, I'm not going to look at this year's forward multiple. I'm going to look at 2 years down the road. And then you take into account the growth. Okay? Margins, right? How much operating leverage is built into the business? That also plays a factor. Motivating asks about MU. I do think they can have a good earnings report because the high bandwidth memory right now is ridiculous. And that's a name that if it does sell off on earnings, I might want to buy the dip there. Just because this is a perfect example, actually, Roar, if you're listening. Micron is a perfect example of a double whammy you want in investing. It's earnings per share growth, which over the long term, stock prices follow earnings per share. So Micron is seeing abundant earnings per share growth. I'll show you right now. So that's going to push the stock higher. I mean, look at this. From 62 to 240. Why is this happening? Two reasons here, guys, that this is happening for Micron. One, earnings per share growth exploded to 121% expected this year. Just for context, okay, follow me here, guys. Stick with me here. Earnings this year are expected to be $18.33 per share, okay? 6 months ago, earnings was expected to be $12.21. There has been a 50% increase in earnings per share expectations in 6 months for this year. That's number one, why the stock has exploded higher. Number two, because Micron's business is now starting to be made up more of high bandwidth memory, which is considered more secular growth because of data center tailwinds, memory needs. It is now drowning out the cyclical part of their business, which is DRAM and NAND, which are other memory markets that are a little bit more cyclical, actually much more cyclical, because they are in like end consumer markets like PCs. Because no one was really paying a high multiple for Micron because they'd post like $6 earnings per share this year, then $5 next year because of the supply gluts in DRAM and NAND memory markets. But now that Micron is selling high bandwidth memory to data centers for all these AI needs, it's much more reliable. It's less up and down. It can be more properly projected, and there's more growth. And so what you saw here with Micron from the move to 60 to 240 is a huge increase in earnings per share expectations and the multiple in which the market is willing to pay. That is called the most beautiful double whammy in investing. And that is what you should really be trying to look for. This is an inflection point in the business and a reason why the market says, hey, I am not willing to pay 6 times anymore for your business. I am now willing to pay 13 times. And that is a picture-perfect example for your question, War. My goodness, am I handing out nuggets today? Oh my goodness. You know, it's crazy because I paid over $100,000 for the information that I got in school, plus a real-life experience. And you guys are getting it on a TikTok stream. Life is crazy. Life's crazy. Do you think there will be a day Bitcoin is nearly worthless again? No. I mean, quantum computing is probably the biggest risk to Bitcoin, but there will always be speculative traders. I don't think it'll be worthless. There's a market for something always. There will always be people claiming, oh, there's a revival, or just purely off speculation, man. Oh, by the way, did you guys see Luminar Technologies today filed bankruptcy? Today, this is like the 1 year anniversary. I said, give it like 12 months, they will file for bankruptcy. And it was almost at like exactly 12 months. Like if you go back to my December live streams from last year, someone asked me, I wish I knew what stream was because I've streamed like 75 times since then. Someone asked me, one company you think is going to go bankrupt? I said, give it 12 months, Luminar will go bankrupt. And that they did. Today they announced Chapter 11. Piece of shit company led by a piece of shit founder, down 60% today alone. Guys, this is what happens when you are trading at 100 times sales and think it's wise with no profitability or free cash flow for another 5+ years. And you think it's wise to raise $600 million in debt, and instead of using that debt to float you until profitability, you buy back shares. You buy back shares at 100 times sales, thinking your stock is cheap. And then when you have no more cash left because you paid for it at a $4 billion market cap, and then you need cash, oh, you got none left, and now you're on the hook for all that debt. And to make matters even better, as they are buying, as they're using that debt to buy back shares, the CEO and founder is selling into the share buyback program. That's what this is. That's exactly what this is. I also found it extremely ironic that someone in Luminar headquarters was dating Elizabeth Holmes from Theranos. Or Theranos, however you pronounce that name. I just found it very funny that she was walking through those same offices, like Luminar offices. If I was the Luminar CEO and one of my employees was dating Elizabeth Holmes, I would have said, I don't care if she's here to bring the whole office warm-baked cookies. The publicity of her walking around these halls, get the F out of here. So I thought that was kind of funny. It's like everything that he touches goes to shit. I think there was even a picture of her wearing a Luminar shirt. So, you know what's funny? I did so good on this stock. The Cube guys did so well on the stock. When they IPO'd as a SPAC, we made 4 times our money. We got at the SPAC at 10. Average dude sold at like 35, 40. Okay? We killed it. And then last year, not only did I make that kind of money in 2021, I then shorted the company and made another 30, 40%. And I would have made 99% return, okay? I would have made 100% return almost, but I couldn't keep holding the short because the borrow rate went to like 35, 40% APR. When I got that notification from Schwab that was the fee to borrow Luminar against Luminar, like borrow share short, I said, all right, that is all I need to know. The only way that fee is that high is because this is a shoo-in. The powers that be know that they're going to throw the towel in. They're going to restructure. The second they got rid of the CEO and founder and brought in a guy that works in restructuring, I'm like, all right, I know what they're doing here. Nick, I have no interest in Capital One at all. If things get rocky in the economy, you really want to hold a credit card company? What's the format for the Cube meeting on Wednesday? Free for all. Free for all. Almost very similar to this. But the difference will be, Corey, we will be talking about everything. So, like, you know how people on stream here ask me, like, hey, Bez, what's your top holding? What's that robotic stock? Or what's that space stock? Or what's that this stock that you love that you think is going to go 10x? Yeah, I don't say it on stream here. But we could talk about it all day on Wednesday night's private stream on Zoom. And for those that are watching, if you've loved anything I've been talking about today and are looking to see what I own and you want to learn even more, give the subscription a look-see. You can check out the 3 different plans. We got the green, the red, and the blue. Although I will say the red plan is the best one because you get access to my portfolio, the private live streams, all that stuff, but you also get access to the group chat, which is so much fun. We're debating stocks and the economy all day. You get my monthly models and research reports, and we meet quarterly. But no matter what plan you choose from, we will have a 2-hour meeting, which is, if in my opinion, forget the monthly membership. It's worth the whole year membership. Did you send out the link yet, Ruben? Yes, I did. I sent it out last week. I think on Thursday. Greta, how you doing tonight? Nick, I like Uber. I'm a fan of Uber. I think good CEO, should grow EBITDA at like a 20-30% clip for the next 3 years. I can justify the valuation. I like how they're approaching autonomy on an asset-light model. I like it. I think they're well-positioned. So I'd love to see you guys in here so I have that opportunity to talk to you for 2 hours. But I do think I'm going to take Ruben's advice, though. Ruben's been telling me for a long time you cannot do a monthly membership. It needs to be like a 6-month, requirement. I think I'm going to probably meet halfway with Ruben and probably do like a quarterly subscription. So you get billed every 3 months. I'm probably going to look to do that maybe in the new year. As far as discount codes and all that stuff goes, I'm done giving out discount codes for a long time. I've been more than generous. And I know I'm properly and appropriately priced. So would love to see you guys give this a shot. But yeah, so right now it is a monthly. It bills every 30 days. But I think a high probability I'm going to go to a 90-day billing cycle. So bills quarterly, 4 times a year, as opposed to 12 times a year. This way you at least need to stay 3 months. Yeah, motivating. You did, man. You did. Listen, you were asking for it for a while. But I got to stop putting myself down like that, man. I know the work that I do. Nick, I'm not a fan of Tesla. I don't think that Musk is going to achieve L4 autonomy with a Cameron AI stack only. And I think that's what the success of that stock hinges on. Greta says, I like the newsletter you send out. Thank you. Yeah, of course, Greta. So if you guys are not, that's a good point. If you guys are not ready to join one of the monthly plans, if you'd like, I do write a free newsletter that I send out every Monday morning at 8:30 a.m. Eastern time. So if you want to check that out, this one's completely free. If you guys want to check that out. If you guys don't like subscriptions and want to hop on a one-on-one call, we can do that too. Dr. Andrew Lewis, how's everything going? Mag 7. I'm split on the Mag 7. You know, it's funny, only 3 Mag 7s are outperforming the SPY this year. Motivate, have a good night, man. Good seeing you. So like when I look at the Mag 7 for next year, because I'm a long-term investor, I'm gonna favor Microsoft, Amazon, and Google as a top three. Yeah, that's all I'm looking at next year. But yeah, funny enough, they're this year 4 of the 7 Mag 7 are underperforming the SPY. Braden, PDD's numbers are nice, but I don't have any care for Chinese stocks at all. Fundamentals don't matter. They don't matter. I've seen plenty of Chinese stocks trade at negative enterprise values, man. So when logic is out the window, then I just think a lot of Chinese names are just momentum swings. That's really it. Yeah, I would agree. I think Google is probably a little not expensive. I think fairly valued now after this run. I was of the mindset that they were going to split up the company, right? Because they were getting such a low earnings multiple. Like, they were very much being valued at their search engine multiple. But so I thought that was going to pressure the board to do a breakup of the company. So this way we could, own Waymo on its own YouTube on its own Gemini on its own. But now that the stock has run, it's probably out of the question now. Another thing I want to talk to you guys about was the SpaceX IPO. I cannot believe. So they raised money at like a $400 billion valuation in the summer. Now they're letting investors cash out at an $800 billion valuation. So somehow the stock has doubled in value over 6 months. And now they're talking about a $1.5 trillion IPO second half of next year. How did this all of a sudden happen? How did we all of a sudden go from a $400 billion valuation to $800 billion 6 months later? And then now we're talking about another double on top of that to 1.5 trillion next year. Unfortunately, man, that is the sickening reality of the environment we're in today, where the second these discount brokerages came out, like the Robinhoods and stuff to democratize investing, and we all started being able to get our hands on these companies, they have privatized the gains now. Venture capital, private equity is like, okay, how do we keep the little man out of our business because they just stepped into our domain? Oh, I got a great idea. Keep all the money private, put together legislation that says they need to be accredited investors to get in on it, and we'll have our own little fun league to get in on and have fun and get our returns to outperform the market to justify our stupid fees. And then we're going to take it public just to use the little man as a liquidity pool. So, unfortunately, for those that are probably going to ask me, oh, are you going to buy the SpaceX IPO next year? No, I'm not. I'll tell you right now, if it's coming public at $1.5 trillion valuation, I'm not buying it. And then you just think about like how many less stocks are public today, and like they're keeping these unicorns private, and they're taking them public at $100-200 billion market caps. Like, dude, they're just done leaving any meat left on the bone for us. So I really hope, because I always ask myself, like, what's the next stage for Cube? I really, really hope that I could launch some kind of VC type arm and help the little guy get in on these up and coming private companies, man. Because it just makes me sick how they've taken their ball and gone home the second retail shows up and can start buying stocks without having to pay a $15 commission to Fidelity, or at my time, Scottrade when I started investing. I was paying $12 or $10 a trade in and out, $10 to buy, $10 to sell. It's like, just nailing me because so essentially if you had $1,000 or $2,000, you're getting screwed. Yes, Greta, you can buy things like DXYZ. You can buy things like ARC VX, things like that. That is cool. I'm a huge proponent of them doing that for us, but they are in their later stages. So like you're not going to get, for example, I have a guy in the Cube family in the group chat. He's going to end up making, I think, 20x on his, if I'm remembering correctly, on his SpaceX investment. He's a accredited investor from Canada. Okay. He might actually have, I don't know if he has dual citizenship. Whatever, it doesn't matter. Accredited investor. He's going to make 20x on his SpaceX investment. You're not getting that. That's what I'm talking about here. Because I love the companies that are in like ARC's investment fund. In fact, I think that's where Kathy Woods excels greatly. I think she would be a fantastic ARC, a fantastic like fully fledged private equity, venture capital type player. Because a lot of times her ambitions don't really pan out in the public markets. So I do like her fund, and I love the names in them, and I wish they'd go public earlier. But the sad reality is that by the time they come public, they're going to leave modest returns left for us. So any IPOs, and there's been quite a few that have been public this year, they've been duds. Did you guys see me wave the flag on Fermi? Who here remembers me talking about Fermi? FRMI. There's got to be a couple of you that remember me talking about this name. I think there was some kind of politician involved. Company was established in January. Okay? I said, how the hell is this company already worth $15 billion? They just formed the LLC in January. Yeah. Did anyone read my newsletter this morning? I said, I'm not touching this stock with a 100-foot pole. Look at this Fermi. Look at this. Look at this. 30, what did it peak at? 37 to 8. 37 to 8. Just absolutely clobbered people. Okay, this is down 70% from the IPO price. Forget about what it opened at. Talking about like an 80% drop already in a matter of 2 months, 3 months. Talking about, look at the termination of contracts already. Like, come on, man. Of course. Who the hell can start a company that's already worth $13 billion within the same calendar year? Come on. It's just ridiculous, man. So this is the IPOs we have to deal with today. So any IPO that happens, no matter how excited I am about the company, chances are I'm going to wait until the lockup period expires, which is usually around 180 days after the IPO, because I want to see what the insiders do, because us retail investors are liquidity. We are their exit liquidity. Here's another one for you. Circle. Oh, let's just run all of a sudden, boom, run to 298 and then dump to 75. Beautiful job. Gemini. What is it, Gemini? Gemmy? What is it? Gemini Space Station. Wow. Hey, thanks so much for hitting 45. Now you're 11. What else has gone public, man? Figma. Wow. Thank you so much for opening up at 150. Now you're down to 35. Thank you so much for the blessed opportunity to go public and give me a shot at this company. All of them are down 70, 80%. I don't touch IPOs anymore for this reason. Since the pandemic, it has just been nothing but private equity, venture capitalists just dumping their bags on us to realize their returns for their elite group. The hell with y'all, man. So, we don't chase it. Don't chase it. Don't chase it. See, now maybe Figma makes sense. Now in the Cube group chat, we're talking about Figma. That's all I'm going to say about that. And I could give you probably another dozen more examples of this. So, unfortunately, for us to get above abnormal returns in the market, you kind of got to do some deep research. It's got to be a company that's not very known. You got to maybe buy a significant dip, get your hands a little dirty on some falling knives, things like that. I think an accredited investor is like a $250,000 a year or something like that. What's the exact definition? And I think there's legislation going through right now about trying to turn this around, but we'll see if it happens. To be an accredited investor, individuals generally need a net worth of over $1 million, excluding primary home, or a consistent income over $200,000, $300K with a spouse for 2 years, plus expectation for the current year, or hold specific professional licenses like the 7, 65, or 82, which I don't even think applies to me anymore because my license is expired. So, yeah, Roar, that's what you're looking at there. Darren, I'm not really a fan of Path. I think it's valued more than fairly now. Yeah, man. So it's like they make their own little thing, and I think I do think there's some legislation going on now. But but this is what kills me, because this has been the case for a while now. This whole accredited investor thing, and I hope they allow the little man to play in the space, in the private equity space. But here's the crazy thing, right? They'll tell you, hey. If you want to invest in these up-and-coming companies that you're excited about that are private, You gotta be worth $1 million, man. Oh, but if you want to put a 15-leg parlay on Sunday night's games, knock yourself out. Oh, and by the way, I'll even give you a promo code so you could do it even easier. Fuck you. You don't care about my well-being. I see ads left and right about gamble this, gamble that. They do. Oh, you want to play trade options? Here, have fun. Oh, you want to have a 5 times levered ETF? Go ahead, knock yourself out. Oh, you want to own Farcoin? Go ahead. But the second I want to own some stock in SpaceX or up and coming private company that I'm really excited about that maybe has some legit value. No. You need to have $1 million net worth there, buddy. What gives, man? Come on. Screw off. You don't care about my financial well-being. Come on. If you did, you would make a lot more stuff illegal for us to touch. But you don't care about our money. You just want to fleece us. Anything where there's real opportunity, hey, they can't play with us. Roar, that's funny. Yeah, this is just me chilling, man. This is just me everyday Bez just chilling. But dude, this is what I'm talking about, man. So what I do for my Cube subs is try to find those home run investments that nobody is talking about. You know, there's a few that I'm up multiple times in my money that I still think can go another 5 to 10x. We were talking about it today because I was modeling out one of these companies that we own about where I think it could be by 2030. Because usually my models are price targets for the next 12 months. But someone was like, Bez, like, where do you think the stock could be in 5 years? I was like, if you want, I can actually give you a specific number. But let me work on my model. So I had to fast forward my model 5 years, bring forward the calendar year to 2030, and then make an assessment of where the stock would be, assuming my predictions and projections are correct. And it was implying about another 5x upside when many of us are up already 2x, 3x. So that would be like a nice 10x gain for us over the course of like 8 to 9 years, which is really, really exciting. For some people, 5 or 6 years, 10x is insane. So those opportunities still exist on the market, and I put it on myself, and that's why I think my subscription has such value, because I am digging through the weeds every single day to find those opportunities. And that is why I've been going live now for over a year, and no one really ever mentions the stocks that I own, especially the smaller cap ones that have that higher potential return. Because I'm not looking for stocks that are on Reddit. That's like, forget it. That's out there in the public now. You got to go where no one's talking about. You got to go where the puck's about to be, not where it is today, Gretzky style. And that's what people pay me to do on a monthly basis. And I hope I can have that opportunity to share those names with you guys. I think you'll find them very interesting. And I think a lot of people are starting to do this because they're like wondering, well, how much more return can I get out of the Mag 7? And I think there's another aspect to this where it's like, and I mentioned this early on stream, where people are talking about the Mag 7 in a little bit of a different light now, because they're saying to themselves, hey, these aren't as safe and secure anymore because they're starting to jeopardize their balance sheet with debt to pursue these AI initiatives that we don't know will produce a return. And then people are all saying to themselves, well, hey, look, man, like, how diversified am I really? These move in tandem with one another so much. And then now they're talking about the circular argument, or the circular financing, and how they're all in bed together. And then they're talking about, well, you know, how much more upside can we have at a $3 trillion market cap, $5 trillion market cap? I should probably expect lower returns just from law of large numbers. And then they're saying to themselves, well, you know, 4 of the 7 are underperforming the SPY this year. So now I think people are starting to say, hey, Bez, find me some stuff no one's talking about, because I really do wonder how much more upside really is still left on these $4 trillion, $5 trillion companies. And I think that's where people are going to continue to look now over the next decade. And then you have this other argument, which is you have these up-and-coming technologies, like I mentioned to you, physical AI, geospatial intelligence, you name it. In today's day and age, if you read books, it's about companies that can also pivot extremely well. And I look at some of these larger companies, like cruise ships. A cruise ship is massive. Don't want to get in the way of that thing, right? Stay clear of that drift and that undertow. But if you need to pivot on an opportunity, those things are hard to turn around. They take time to turn around. Whereas these up-and-coming companies are like jet skis. They could pivot on a dime, and they could be the next up-and-coming companies that challenge some of these larger ones. Now, granted, it's going to be tough to beat out like a Google, for example, that's doing something in quantum computing because of the sheer amount of resources and cash that they have and the talent that they have. But in other areas where there's maybe some kind of differentiated technology that's protected by IP or that's been operating somewhere else, I've been reading a lot about how interesting it is that the up-and-coming companies that really come and threaten a domain usually don't even start in that domain. They're not even considered competition. Very similar to how like when Amazon got started, right? Amazon was selling books online. So like a lot of companies weren't even taking them seriously before then they started branching out and doing more e-com stuff. So like they weren't even considered a competitor yet, but they were proving their business. So like they started with they became a really big fish in a small pond, showcased that this business model works, and then expanded and then took competition by surprise. You could say the same thing with regards to Apple. I don't think that HP and Dell were thinking too much about Apple because they operated in handheld devices. Little did they know that, forget that Apple would then get into the MacBook space, sure. But before that, really, with the power of the processing in your hand, I sound like Doc Ock from Spider-Man 2, it actually challenged the computer as well because the phone essentially became a computer in your hand. So again, it caught them by surprise. It came from a competitor that didn't even think was operating in their market. Could probably argue the same thing about watches, with all these people wearing the iWatches and stuff. So there's countless examples of this. So I am looking for that is what goes into my thought process when I'm looking for these up-and-coming companies. They're not very common, which makes them very, very difficult to find. I will say that because there used to be like 5,000 stocks in the market. There's a fraction of that today because of so much consolidation. And again, back to my original point about how many of them stay private. So, like you saw, NVIDIA bought out another company today. I'm pretty sure they're buying out a company like every 3 to 4 weeks at this point. It's insane. It's insane. And all those private investors are making a killing. So, I'm trying not to get too off topic, but I do think if you're listening to what I'm saying, I'm dropping a lot of gems that I hope you guys are taking into account. I'm coming up on an hour and a half live here, guys. Hit me with some more questions. Do you guys have any questions about maybe for the newer guys here, what a subscription entails? I'd love to answer those questions. Anything else, feel free to hit me with them. Debating company 401k if I pay $1,200 a year allows me to more openly invest, not just typical funds. I would consider it then, Andrew. What's your company's match? That's another big question because that's like free money. Oh, today was a good stream. Not a whole lot of guys in here today. I don't know why that is, but let me tell you, like the talking points I was able to get to because of not answering too many questions, almost like just talking to myself tonight, really allowed me to go off on a continuous thought. I know on most streams I'm getting like a lot more engagement. I'm not sure why tonight. Maybe Monday Night Football. I don't know. But I'm always answering tickers in like a lightning round basis, so I don't really get to have the same train of thought for too long. Darren Waller, 2 touchdowns today, huh? That's cool. Start doing Monday monologues. I honestly, I think you guys enjoyed tonight, man. I really do. I enjoyed tonight a lot. I really did. Hey, Brendan, you got the win tonight? Congrats for moving on, man. Congrats moving on. That's going to be a showdown with you guys, bro. Oh, man. Max versus Brendan is going to be lights out, man. Sorry, guys. I'm talking about the Cube Fantasy Football League. But And my pick's on you, Brandon, to win it all. So yeah. I thought today was a fun stream. I'm probably gonna wrap it up here, but again, guys, at a minimum, join that free weekly newsletter on my website. If you guys not sure how to get there, you just go to my TikTok page. It will be right below where it says "Get Cubes Research and Insights." Okay. And if you ever forget, it's my handle. It's just CubeWealth.com. The same way you see my handle here on TikTok, just type in .com or just type in CubeWealth on Google. I'll come up. And then what you can do here is click free newsletter, and you can get here to this page, put in your information, click join, and again, if you want to be part of the Cube, of course, Doc, absolutely, yeah, absolutely. No, and whatever plan you subscribe to, we hop in a 2-hour meeting, so I have the opportunity to walk you through my portfolio. When you subscribe, you get hundreds of pages of research on my holdings, accompanied by my financial models, so backed by actual numbers and why I believe a stock should be worth what it's worth, along my rationale and reasoning and supporting the thesis for it. And then you also get my annual outlooks that are 150 pages long too, where I think there's opportunities in the economy, the good, the bad, the ugly, how I'm situating myself, all that kind of stuff. All right, Zach, sounds good, man. Sounds good. Absolutely, we can get you upgraded, man. Zach here is a green member. He's upgrading to red. That is pretty annoying. That is pretty annoying, Andrew. Dang. But yeah, I have some really interesting ideas for you. And the reason I like the onboarding meeting, that's 2 hours long, is because it allows me to also explain the risks of the investments that I'm in. Obviously, I can't tell you what to buy, but it gives me an opportunity to say, hey, these are names I'm invested in. Here's my allocation. You don't have to memorize everything because it's all written in these documents. And here's the risk that's entailed. This is the pros to this stock. This is the downside that could potentially happen here. This is what could send it through the roof. This is what could send it much lower. And I like having that ability to walk you through it. But I always have to preface when these meetings start to not get too excited, because I get pretty excited talking about these names because I'm really excited about their future. And you have to make a promise to me that if you do end up buying them, again, it's your decision, you don't make it your entire portfolio. Ruben, I think that's, so like, it's the end of the year. I'm doing a lot of thinking of what I could do better next year. I'm thinking I go to a quarterly subscription basis. This way you have to stay a minimum 3 months, and it just bills 4 times a year, as opposed to monthly right now. And then I'm actually shutting down my old podcast. I'm going to rebrand, and I think I'm going to start getting into podcasting again for 2026. I want to do a whole rebrand, change the name of the podcast, and be way more consistent with it. I think that's going to be on my 2026 goals. Ruben says onboarding meeting worth the subscription alone for the year. Appreciate you, man. Appreciate you. And our quarterly meetings are great too. Our quarterly meetings are great. So I do think that I got to get deeper into the podcast game. I know a lot of you people like it. There's also a lot of people that don't have TikTok that want to watch my live streams, but don't. So I do think I'm going to rebrand and start 2026 with a fresh slate, change the name of the podcast, start with a clean slate, and talk about the markets. I think you guys will like that a lot on Spotify and Apple and all that good stuff. So that's on my 2026 to-do list. I am going to start posting. I just posted one of them. I'm going to post more. These streams, I always post the whole recording on TikTok, but now I'm also posting them on YouTube. So if you guys ever want to watch the entire stream, you guys can also watch the full replays on YouTube now. I'm going to be posting them there as well. Doc, please, again, if you're not happy after joining, there's no contracts or cancellation fees, man. If you're not happy, we part ways. Does it happen often? No. But I have been doing this full-time for over 8 years, and I have over 200 members that I've been doing this with. So I look forward to you being part of the Cube family. And again, I really recommend the Red plan just because I'd like to meet quarterly with you. I think that's huge value add. The monthly models that I issue are so fun and so insightful. This month's models are going to be on Netflix, Amazon, and one other company, which I'm withholding saying because it's a under the radar company. And you also have the group chat access, which is a huge networking opportunity with a lot of awesome like-minded individuals that are doing great in their careers. So the red plan value is solid. That's $100 a month, and I think you'd find it to be very much worth your time. And you can always upgrade, downgrade as you see fit. So guys, give it a look-see. Again, my website's CubeWealth.com. My name is Bez. Appreciate you guys being here tonight. And any questions pop up, you can always reach out to me at help@CubeWealth.com if you want to shoot me an email. When I say my models, this is what my models look like, just so you know they're not like Fugazi. This is one on Spotify that I issued to my subs. Modeling out subscriber growth, average revenue per subscriber, gross profits on each subscription style, how sales and marketing breaks down, how research development breaks down, general admin, forecasting out future free cash flows, discounting them by the weighted average cost of capital, applying some buffers in the discount rate and the perpetual growth rate in the free cash flow margins to arrive at bull, base, and bear case scenarios so you can see what a good day looks like, what a rainy day looks like on the stock, and so on and so forth. So I issue these models every single month to the red and the blue members. The base green plan does not get that. So I that's why I say the red plan is just so key. And again, this month you get access to the whole library, by the way. So you get access to a Google Drive that looks like this. So you get access to my CubeFolio reports. So if you want to see how I did in 2023 or 2021, all right, I post them. You can also see my models. So like Waste Management, Wix, Visa, UPS. You know, they're all here. Some of them I still have to update because obviously the calendar year is flying by, so they need to be updated. But I'm always uploading. So you get access to the whole library as well. You don't just get access to the ones going forward. You get access to the ones I've been doing. So it's really like I consider myself like the Netflix for investment content. So I think you guys would find that pretty fun. And I don't really find many people, A, focus on long-term investing, and B, finding unspoken stocks. Like most people are just like crowd herding. And three, actually supporting their investments that are backed by models, by discounted cash flow models and research reports. Like if you look here, look, this is a model. Hey Doc, you might like this. You know the company Hims and Hers. When back in October of 2023, when I issued this document, the stock was $6. I did a 45-page report on where I think the stock could go, along with an attached model, the pros and the cons, the risks that are out there. You know probably better than anyone, Doc, the kind of risks that are out there and regulatory concerns. I drew the parallels with Smile Direct Club and how the group of orthodontics came at them, man. So that's another thing I do in these reports. So I just dive deep into the weeds and see what I can find. And I think you guys will have trouble finding that elsewhere. So, guys, I'm going to end there. Again, give it a look-see. And to the group chat guys, the Cube family guys, I will see you guys in the group chat tomorrow. And I will see you on the private stream Wednesday night. For those that can't make the private stream Wednesday night, I will be posting the recording. It will be recorded and uploaded, so don't worry. To those watching that are going to be on that live stream, turn your mics on and turn your cameras on because I want to have a nice back and forth discussion where everything's on the table because I do leave a lot of stuff, off the table here on these streams. Guys, always good talking to you all. Have yourselves a good night. Good luck with these markets, and we'll talk soon. Take care.